Introducing GammaSwap. GammaSwap is the modular DeFi scaling layer. The protocol compensates liquidity providers with higher yields, offsetting their impermanent loss risk. Borrowers, on the other hand, can now get leveraged exposure to any token, turning impermanent loss into their impermanent gain. What is impermanent loss? Impermanent loss is caused by market movement or volatility when providing liquidity. This is because LP positions replicate short straddle positions in traditional finance. Impermanent loss isn't an issue if the returns make up for that loss, but the problem is LPs are compensated in volume or swap fees. Due to this discrepancy, most LP pools are not profitable to provide liquidity into unless compensated by extra token incentives. GammaSwap aims to solve this problem by creating a two-sided volatility marketplace. Liquidity providers from other AMMs will earn the swap fees plus additional borrow fees from those borrowing liquidity. Those fees are based on volatility and should compensate LPs adequately without relying on highly inflationary token incentives. GammaSwap is Oracle-free and modular, so the service can work for any LP pool. On the supply side of the market, users can deposit their DEX LP tokens from Uniswap, SushiSwap, or Balancer if they're already providing liquidity. If they aren't, they can deposit the underlying tokens of the pool through GammaSwap. They will then receive an ERC20 token called GSLP token, which accrues trading fees from the underlying AMM plus additional fees from the borrowers. This means that the LP positions will always earn more if deposited on GammaSwap, as they will receive both trading fees and borrow fees. Additionally, GSLP tokens will be composable with other DeFi protocols, offering even more utility and capital efficiency. On the borrow side, users can borrow liquidity by providing the underlying tokens as collateral. When a user opens a long volatility position, GammaSwap will exchange LP tokens for the underlying tokens. The borrower receives an ERC721 token that represents the borrowed position and has to pay an interest rate based on the utilization of the pool and the trading fees the LP position would have earned had it not been burned. The borrower will have to pay additional borrow fees to the LP based on a dynamic utilization-based interest rate. If the market moves in either direction, the value of the user's position will increase relative to the LP tokens, meaning they will profit from the price movement. This presents the opportunity to turn impermanent loss into impermanent gain. However, borrowers will need to pay borrow fees based on the dynamic interest rate as a cost for this service. Borrowing liquidity allows traders to profit from volatility in unique ways. For this illustration, we will be using the FXS Frax LP pair as an example. FXS, also known as FraxShare, is the governance token of Frax Finance, and Frax is a stablecoin pegged to the value of $1 USD. With this in mind, let's dive into the unique leveraging opportunities that GammaSwap has to offer. In addition to the normal straddle position, which isn't weighted in either direction, allowing users to profit from volatility on both sides, GammaSwap also enables users to earn impermanent gains through synthetic calls and puts. This opens up exciting possibilities for users, as they can now go long or short on an asset by adjusting the collateral ratio. For example, if you wish to go long on FXS, you will provide more collateral on the FXS side. This becomes a leveraged position. When FXS experiences a price increase, the profit will increase exponentially, similar to a call option. On the other hand, if you wish to bet against FXS's price action, you will choose to provide more collateral in Frax. In this scenario, if FXS drops in price, you will profit from it, similar to a put option. GammaSwap does all of these calculations for you. The trader just adds collateral and selects straddle, call, or put. It's important to note that for the straddle, call, and put positions, if the price of the underlying tokens doesn't move, you can get liquidated as the interest rate will eat up your collateral. If the price moves away from you far enough, your position P&L would still be positive. This is different from traditional perps trading, where you can get liquidated if the price moves against you. In summary, by using GammaSwap to long or short an asset, users can earn exponential return without the liquidation risks associated with traditional CFDs, perps, or futures. Other than addressing the issue of IL, GammaSwap has the potential to offer a range of other products. One possibility is the creation of a feeless DEX if there are enough users willing to take on the borrow side, long volatility. Liquidity providers will be compensated with fees from borrowers instead of trading fees. This would allow the DEX to be competitive with centralized exchanges in terms of fees, making it attractive to retail users. In addition, GammaSwap can serve as a foundation for various other derivative products, including strategy vaults that automate LP hedging, cost-effective options trading hedges, leveraged altcoin exposure, and other structured products on which other protocols can build expiries on top of GammaSwap's options. The potential for innovation and value creation within the DeFi ecosystem is virtually limitless. Thank you for watching this video on GammaSwap. Join us on Discord and follow us on Twitter to keep up to date with our progress.